Are you expecting, Bhanu, a broader repricing of markets as we get into summer 22?
I think as we get into the second quarter of this year, towards the latter half of the second quarter, that's when we really think that tighter liquidity and weaker growth clash. Because right now, I think strong growth will probably keep the market stable, perhaps even moving higher, particularly in reflation areas. I think Europe will actually outperform. But when you start getting towards trend growth, when earnings momentum starts coming down a little bit towards negative territory, that's when tighter liquidity is really going to bite. But we think that that's a late Q2 story. I think the market should be able to hold up for now. I mean, tighter liquidity is a concern because liquidity is a much bigger contributor than growth to market returns. Since the bottom in 2020, liquidity has contributed much more, so that is a concern. But it becomes particularly concerning when growth also comes a little bit lower, which I don't think in this H1 story, that's H2.
What happens after the second quarter? You're expecting markets to peak then, and then are we looking at a huge correction? And what part of the markets will actually be hit first?
Yeah, so we're looking for 48.50 by the end of this year. In Q2 of this year, we think the S&P peaks at 5,000. So I would say a gentle correction towards 48.50. And I would expect that some of the themes that we are seeing right now will reverse. So right now it's a value and it's cyclicals, and we move to, I think, quality and defensives and growth in the second half of this year. But the one point I would make is that I think we have to be quite careful about tech, because there's one part of tech which is renewables, SPACs, and profitless tech. But the bulk of tech actually has very decent free cash flow. It has very decent earnings, and historically, even through periods where real rates have risen, free cash flow and earnings in tech have actually held up much better than in other sectors. So the bottom line is that the beta of tech when rates go down is not the same as the beta of tech when rates go up. Many people think that rates went down, tech benefited, ergo when rates go up, tech is an underweight. I think that might be true tactically. I certainly don't think that's true structurally. I think tech is actually going to be okay because when rates go up, you want to be in sectors that have good free cash flow. You don't want to be in sectors that are cash constrained. And tech as a whole, there are a few exceptions, has very good free cash flow.